Inflation has climbed again, putting more pressure on American households.
And all of this weighs heavily on the Federal Reserve's upcoming decision next month on potentially raising interest rates. The September CPI report showed consumer prices were up 0.4% from August, so that's the month on month, and about 8.2% year over year. In a statement, President Biden said, quote, working to give middle-class families some breathing room in dealing with their costs is critical. Today's report, he says, shows some progress in the fight against higher prices, even as we have more work to do. Does it really? Let's bring in Diane Swonk. She is the chief economist at KPMG U.S. Diane, the Fed's raising interest rates to bring inflation down. These numbers suggest it isn't working. What's your reaction? How should we connect the dots? Is that accurate from your point of view?
Well, I think it's important to sort of start of where the Fed is starting from. The Federal Reserve believes that it first moved into restrictive monetary policy territory, that's tighter credit conditions, when they raised rates in September by 75 basis points. Before that, they thought interest rates were at zero, were at neutral. And I think that's an important starting point because it's why the Fed has been so reluctant to say that it's going to stop, hitting the brake. And now, in fact, we're going to see, I think, easily another 150 basis points or 1.5% by the end of the year, taking that short-term interest rate up to 4.5% and likely up to 5% in 2023. What's important, though, too, is at the same time, the Fed is reducing its balance sheet, and that's going to tighten credit conditions as well. And this is not a precise process, and it's very hard because it's nonlinear. We've already seen the fragilities abroad in terms of, some bond market vigilantes in the UK not liking their budget and what's going on there and them backing off, having to back off of that. This is a very important time because we've got not just the Federal Reserve raising rates, we've got those rate hikes ricocheting around the world with central banks around the world raising rates at the same time. And those things will begin to feed upon each other to not only cool off the economy, but slow it down quite a bit as we move into winter.
Well, and one of those indicators about a cooling economy is the labor market, which we've been keeping a close eye on. 228,000 Americans filed for unemployment benefits last week. That's higher than the week before, but unemployment still remains at about 3.5%. Obviously, it is not good news for the Fed that inflation has continued and is now at 0.4% higher than in August. But given that, combined with these new jobless claims, what direction do you see the labor market heading and the Fed heading when they're looking at their next potential rate increase?
Well, unfortunately, we're going towards a collision course. The labor market has held up remarkably well, and that's wonderful as long as you get wage gains that outpace inflation, not wage gains that are underpacing inflation. And so that's not good enough. And the only way to get there is to have better balance in the labor market. And so the Fed is in this really tough place right now where it's trying to bring demand down to meet a supply-constrained world, and those constraints apply to the labor market as well. They can't make new workers out of nowhere. And, short of immigration changes in immigration policy that might allow a better balance and more real wage gains in the U.S. economy, we have this shortage of workers that's feeding inflation in the service sector, and it's very hard to derail without a rise in unemployment as well. We do see a recession as we move into the end of this year in 2023, and that's very painful. From the Fed's perspective, they're looking at it, they look at inflation like a cancer that can metastasize. If you don't deal with it now, you have a much more chronic and severe condition down the road.
All right, Diane Swonk, thank you.